Hi there everybody and welcome to another stock analysis video. Today we are going to be analyzing another beer company that was recommended by, again, HB, since he wanted me to do Heineken and Tap. Therefore today we're going to be analyzing Molson Coors, otherwise known as Taps, which they have a bunch of other brewery companies in them. I believe they also have like Coors Light and that kind of other companies. So again, I'm not really familiar when it comes to brewery, but nonetheless, we're going to analyze their fundamentals and come up with a target share price in accordance to them. So with that said, let's get started with this analysis. Starting off, guys, we're going to come here straight into the dividend summary. Dividend yield of 2.87%, which ends up being around 38 cents a share for an annual payout of $1.52. Payout ratio is 16.39%, which is actually really good, as opposed to, I believe, Heineken didn't have a payout ratio. Now, the 5-year growth rate is at a negative 8.36%. So let's just actually analyze this on the dividend history. As you can see, they have been pretty reliant when it comes to their dividend payments. However, as you can see right here, they did have a gap right as soon as the pandemic started. The last time they paid a dividend in 2020 was right before the whole pandemic started, or at least the market bottomed, which is around March 20th, 2020. And unfortunately, they did not pay a dividend, and just recently, as of August 26, 2021, is when they reinstated this dividend. Which actually makes sense as to the reason why they have a negative growth rate, because they did not increase it to the level that was before, and their dividend growth is 0 years because, again, they did cut it for 2020 as a whole. Now, this in a sense is bad, however, is a COVID-related phenomena. Therefore, I'm not really going to take it into account now that I fully understand as to why this dividend was cut and why the 5-year growth rate is that low. Ex-dividend date was March 4th, payout date was March 18th, and they pay their dividends quarterly, unlike Heineken, which paid it semi-annually. Now let's come over here to the spreadsheet. We got the ticker symbol TAP, market cap of $11.5 billion, PE of 11.46. This is actually one of the reasons why HB wanted me to cover these companies, because they seemed very, very underpriced. As you can see by this PE, according to their earnings, they are pretty much underpriced. Now, with the current share price around $53, is this really underpriced? Well, according to the earnings, yes. However, according to all other metrics, not necessarily. We're going to take a look at that in just a little bit, so stay tuned for that. Annual dividends, as I said, was $1.52, which ends up being around 329.8 or around $330 million being paid out in dividends every single year. And after we take the 5-year average free cash flow and we subtract the average 5-year free cash flow from the dividends paid every single year, they're still left with around $954.5 million. This means that their payout ratio in regards to the free cash flow, this is different than the payout ratio that we just saw in regards to the net income, is at around 25.7%. Still very, very healthy. In my opinion, anything under 60 is pretty good. Therefore, 25, right, 26 is actually really, really good, meaning that they can actually continue to increase this dividend into the future, assuming that we don't have another phenomena like COVID. Now let's come over here and we're going to take a look at the fundamentals. Net income 5 years ago of $1.6 billion to 1 year ago of $1 billion. Guys, that is a decrease of 36%. That is massive, right? Obviously, the big outlier here was 2 years ago at $949 million. However, this was a COVID-related number. This 2 years ago is actually from 2020, therefore I'm not going to count it. However, take a look at 3 years ago. 3 years ago, they did $241.7 million, a significant decrease from 4 years ago where it was $1.1 billion. So they were pretty much on the downtrend ever since even COVID happened, right? And even after it rebounded, well, they didn't even rebound past the 5 years ago mark at around $1.6 billion, making it a huge decrease. If you take a look at the overall trend, this is pretty much just telling me that they might continue to go down into the future when it comes to their net income. Probably not in the negatives, however, they might go down less than $1 billion in the following year. Now coming over here to the free cash flow, cash from operations less your capital expenditure, the lifeblood of the company. Guys, 5 years ago of $1.3 billion to 1 year ago of $1.1 billion. That is a decrease of 17%. Average 5-year free cash flow is around $1.3 billion. Now, again, this is very, very interesting because 2 years ago when they had COVID, well, they went down to $1.12 billion, which is understandable. However, 1 year ago, they still continue to go down to $1.1 billion. So as you guys can see, the overall trend when it comes to the free cash flow is essentially going down. Yes, they did have a good year 4 years ago. However, it's just an outlier at this point. The trend line is continuing going down. Does this mean that today or this current year they're not going to be significantly higher than $1.1 billion? No, not necessarily. But if you just take a look at the overall trend within the past 5 years, they pretty much are going down. To me, this is a major risk, especially when it comes to the free cash flow. Now let's take a look at the revenue. 5 years ago of $11 billion to 1 year ago of $10.3 billion. That's a decrease of negative 6.57%. Again, very, very surprising, because even though in 2020, when we did have COVID, they did go down to $9.65 billion. However, 1 year ago, they did slightly go up, but it wasn't even enough to surpass the 3 years ago number at $10.6 billion. So again, we have another metric that is trending down. This is not something that you want to see if you want to hold a company for 10 to 20 years. Now let's take a look at the total assets minus the total liabilities. Now guys, this simulates if the company were to liquidate all of their assets, would they be able to cover their liabilities, and how much money would they have afterwards? And as you can see right here, very, very similar to Heineken, they're all in the negative. What this is pretty much just telling me is that in this industry, they are not able to cover their debts. Now, if this is an industry thing, you might be willing to ignore this, right? Obviously, this is like the second company I've ever analyzed that has to do with beer, so I am not aware that this is an industry thing. However, if you guys take this calculator and you take a look at other beer companies and you see the similar trend when it comes to their assets and liabilities, then it's probably an industry-wide thing, right? It's similar to like how telecom usually has a ton of debt as well too, pretty much all across the board. Probably the same thing applies to this type of industry. Now, currently guys, if they were to liquidate all of their assets, they would have negative $843 million, meaning that they would not be able to cover their liabilities, and, well, they have more liabilities than that of assets. Now, have they gotten better within the past 5 years? Yes. I mean, 2 years ago, they had like, what, $1.5 billion? Negative $1.5 billion? 3 years ago, it was $1.51 billion. 4 years ago, $1.53 billion in the red. So yes, they are trying to cover their liabilities better. However, we are still in the red in the several millions of dollars. The average total assets is around $2.5 billion. Average total liabilities around $3.8 billion. Average assets minus the average liabilities around negative $1.2 billion. Now guys, let's take a look at the silent killer when it comes to investing. The shares outstanding. This right here tells you whether or not the company is diluting you as the investor. The way that I always mention it is, imagine if you have 10 people and you want to buy a pizza for those 10 people. Well, the average amount of pizza that each person gets, assuming that they all get it equally, will be a certain amount. Now let's say you double the amount of people to 20 people. If you still buy the exact same pizza, now you have to divide that pizza among 20 different people. The slices per person is actually going to go down. Same principles apply right here. The more shares that are outstanding, the more shares the company issues, the less ownership you have of the company. Therefore, you want this number to be coming down. Now, 5 years ago, 215 million shares to today of 217 million shares. Again, very, very similar to Heineken. A small increase within the 5 year, and well, from the previous year to the current year, this is taking it from 2 years ago to 1 year ago. It is another small increase of 0.14%. Now, guys, 0.74%, right? 0.75%. That's not really a lot. To me, this isn't much of a concern. For all intents and purposes, yes, it is a metric, but honestly, it's not really that bad in my opinion. And lastly, we got the cash equivalents, and as of today, guys, they only have a mere $637 million with an average cash and equivalents of $674 million. Now we need to make some assumptions, low, medium, high, using 3 different factors: revenue growth, projected share buyback, and the required rate of return. For the required rate of return, guys, I'm going to keep it the same, 10% for all 3 assumptions. Revenue growth, I'm taking them from the growth tab of Seeking Alpha, and I'm kind of making an estimate between the revenue growth year over year and the revenue growth forward. The projected share buyback, I am taking it from the shares outstanding that we just saw, and I'm kind of making assumptions to where they may go in the future. Positive projected share buyback means that they're buying back. Negative means that they're issuing. Now, for my lowest assumption, I'm going to assume a growth of 3%, projected share buyback of 0, meaning that they're not going to buy or issue shares. This comes out to be a target share price, not adjusting for debt, of $53.54. Median assumption, I'm going to assume a growth of 5%, projected share buyback of 0.5%, meaning you're going to buy back shares at 0.5%. This comes out to be a target share price of $57.69. And from highest assumption, revenue growth of 7%, projected share buyback of 1%, this comes out to be $62.09. Now we need to adjust for debt. The way we do this is we take their cash equivalents and we add the net debt. If they have more net debt than cash, then this number will come down. If they have more cash than debt, then this number will come up. As you can see, it comes all the way down to $22.07 for my lowest assumption, $26.06 for my median assumption, and $30.31 for my highest assumption. Now, me personally, I like to add a margin of safety, 5, 10, and 50%, because I always make the analogy of if you're building a bridge and you know that minimum you require 10,000 pounds to build that bridge, then that means you need to build that bridge for 15 or 20,000 pounds because you want to add a margin of safety. Same principles apply right here. Now, for my lowest assumption, adding the margin of safety, I would like to buy this at around $18.76 to $20.97. For my median assumption, it is between $22 to essentially $24.76. And for my highest assumption, between $25.76 to $28.79. Now guys, seeing that the current share price is $53 essentially, right, we're 4 cents away from that. Pretty much the only numbers that fall within this, it is essentially my target share prices not adjusting for debt. Therefore, it really is up to you at this point, right? If you believe my assumptions, then it really is up to you if you want to take into account the target share prices after debt. They do have a lot of debt, guys, or you just want to go with the target share prices alone. But then again, guys, if you believe my assumptions, again, these are my assumptions that I use as to where I would place this company. Everybody's different. I have this calculator available for free, and I highly encourage all of you guys to go into my discounted free cash flow calculator videos, or even the playlist that shows all of my calculator videos and like how to use it, and you make your own assumptions. Because at the end of the day, I'm not going to tell you guys what to do. This is not financial advice. I'm just showing you guys the raw numbers and as to where I would place the company. Because at the end of the day, every investment is the present value of all future cash flow. Depending on where you think this company is going, then you should make your own assumptions. I'm giving out this calculator for free. All I'm asking for in return, guys, is like, subscribe, comment. Really does help with the algorithm. We're up to 452 subs. Would love to get to 500 by the end of March, so in about 11 days. I know that's a little bit asking for too much. However, you know, I would love to get my community tab and start communicating with you guys more than just in the comment section. So if you guys can help me out with that, I'm giving out something for free. All I'm asking for in return is something for free. Now let's actually do something that I've been doing in recent videos, and that is the dividends at current price. I wanted to figure out if I were to put 1 month's income into this company, how much would I get in returns when it comes to their dividend? So I took the average US income, which is around $68,703, brought it to the monthly, which is $5,725. And at the current annual dividends per share at $1.52, if you were to put in 1 month's income into this company, this would buy you around 108 shares, which comes out to be an annual dividends of $164.32, quarterly dividends of $41.08, and monthly dividends of around $13.69. Now, this is something that I'm not really interested in right now when it comes to this company, because there's a lot other companies that I have analyzed that have better metrics for starters. And with this kind of money being put into them, you would actually get a significantly more quarterly and monthly dividends. Therefore, the way I see this, yeah, it's good, but compared to others that I've done, this is not really cutting it, right? All in all, when it comes to TAP, honestly, yeah, it is underpriced, I guess you could say. However, guys, they do have a lot of negative metrics, right? I mean, essentially all the trend lines in every single metric is going down, right? They are issuing shares, not a lot, but nonetheless, they are issuing shares. The free cash flow is going down, revenue is going down, net income is going down, debt is slightly getting better, but it's still in the red, right? So wherever you look at this to me seems like a lot of red flags. And me personally, it is not worth the $52.96 at the current price. But that pretty much does it for this video. If you want to follow me on my new tech sites of BitChute, Odyssey, and Rumble, the link is in the description below. I have a Let's Play channel, also link in the description below. So if you want to follow me there, you can. With that said, peace out, and be on the lookout for the next stock analysis video. And if you guys want to recommend one, please tell me in the comments section below.